We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rick Rule, investor, speculator, founder, and CEO of Rule Investment Media. Rick, how are you today?
Tom, I'm doing very well, thank you. It's nice to be on with you. For your listeners' note, this isn't a halo. I'm backlit by sun coming into my office, so I apologize for any visual effects.
Well, I'm sure as the interview goes on, that'll change slightly, but I'm glad, and I'm sure the audience will be glad that it's not a halo yet. Mm-hmm. You know, we were kind of talking a little bit before we hit record here today about your retirement that you celebrated. I guess it would be almost 2 years now?
Yeah, every bit of that, probably a little more. Yeah. Mm-hmm.
And it doesn't seem like you've really slowed down at all to me. You're busier than ever, but you're, let's say, maybe more focused on what you want to be working on, I think.
That's exactly right. I failed retirement completely. I'm delighted about that. What I was able to do is reduce the level of regulatory engagement that I had working for Sprott, paying attention to 3 or 4 countries' regulatory regime. Given, Tom, that I'm starting a bank, obviously I'm not completely divorced from all regulators, but the truth is most of the heavy lifting in the bank is done by the bank CEO, Frank Trotter, rather than by me. So by and large, the parts of working with Sprott that were really frustrating around the interplay with the various alphabet soup agencies in the United States and Canada are things that are in my rearview mirror, and I'm delighted about that.
Mm-hmm. Well, like I say, it seems that you're able to focus more on creating more of your energy on creating the things that you want, rather than, dealing with so much regulation, which, I mean, we can go into that, but maybe we'll need several hours to really cover that topic.
No, it's absolutely true. And I enjoy the process of being interviewed by people like you and the work that we do at Rule Investment Media. I had the extraordinary good fortune when I was a young man to have some incredible mentors and teachers. And to the extent that I didn't pass it forward, that would dishonor the debt that I have to the people who taught me. So this sort of thing is enormously important to me. Mm-hmm. And I enjoy it as well.
Well, I'm certainly very grateful for it. I know I've learned quite a bit from you, and I hope our audience is as well. And I had the pleasure of recently this summer going to the Rule Investment Symposium down in Boca Raton. And I haven't been to many conferences since basically before COVID. And I will say that it was absolutely worth my time. And I think everybody else should check that out. There's something, I think, truly for everyone. And there's, of course, tons and tons of information to learn, and also excellent people to connect with there.
Well, thank you for that, Tom. We've tried to make the conference a little bit better every year, and we've been at it for 28 years. So we've had a long time to learn how to do the conference business. I should note that anybody who chooses to attend my conference, either live, which I would prefer, or via live stream in the comfort and convenience of your own home, does so with a gold-plated money-back guarantee. If you think for any reason that you didn't get your money's worth as a live attendee or an online attendee, just email me and I will refund the price of admission. Mm-hmm. It's worthy to note that we've been doing those money-back guarantees for 28 years, and we've had to refund substantially less than 0.1% mm-hmm. of the course fees that we've charged.
Well, I know for myself, as I kind of mentioned, it's more the connections and the actual conversations that you get to have between sessions that are more important. So for myself, I would absolutely agree. In person is I think the preferable way to do it. But
yeah, I don't want to belabor this, but I had a guy email me 6 or 7 years ago saying that the ability to follow Robert Friedland through the exhibit hall and see what booths he stopped in front of and eavesdrop on the questions that he asked them was worth the price of admission. And they got the whole rest of the conference in their mind for free. So I agree with you. The best way to do it, if you can, is live, because you miss informal conversations in the live stream. The benefit of the live stream for me is that we were able to include people this year from 33 countries for whom it was either inconvenient or unaffordable to come to South Florida. Mm-hmm. And while I believe our live product is better than our live stream product by now over several years has served several thousand investors who we otherwise would not have been able to serve.
So Rick, this really kind of gets at the heart of what I really want to dive deep in with you today about, is this idea of investing in the resource sector, and specifically, let's say the gold and silver sector. Right? We can touch on some of the other stuff at the end, but it's always a pleasure to check in with you and get your perspective on things because of your in some ways unmatched time and experience in this sector. So I'd like to start with asking if there's anything about the current macro environment that could provide a catalyst for the mining space, or is it the profitability of mining companies that is going to start showing and really overshadowing the rest of the sectors to really highlight what is so attractive that we have seen from this sector to bring more generalist, let's say, investors into it?
I hate to sound like an unabashed bull, but the answer to the direct question that you just posed me is yes and yes. I believe that the macro environment is ideally suited to the gold sector, and we can discuss why in a moment. I think, too, that we are at the point now where the increases in gold and silver prices are outpacing the impact of inflation on production costs. People have been disappointed for a couple of years about the fact that the increase in gold and silver prices hasn't been matched step for step by an increase in margins enjoyed by the gold and silver producers. Many people who are new to the sector, the generalists that you described, aren't aware that the last 4 years we've seen rapid increases in energy prices, steel prices, cement prices, labor prices, and in particular social rents, which is to say taxes on and off concession expenditures and royalties. The consequence of that is that a lot of the margin increase has been eaten up by increasing costs. We are just starting to see in the last couple of quarters the impact of moderating fuel price increases against the increase in metal costs. I think 4 weeks ago, we had a quarterly earnings release from Lundin Gold that didn't beat estimates, it obliterated estimates. We aren't out of the woods. The quarterly release that we saw from Newmont last week was the latest in a series of 5 quarters where they didn't match estimates, which was unfortunate. But I suspect that the upcoming release from Agnico Eagle, and the release after that from Goldfields will probably, in my mind, I don't have any material non-public information, but probably begin to reinforce the trend that the industry is actually translating higher gold and silver prices into higher free cash flow.
So the other part of that, which you said that we could return to, is this, let's say, the macro factors here. We've seen the Fed now cut for the first time after this very steep and dramatic rate hiking cycle. So do you think it's a possibility that the Fed cut too much or too soon, or were they reacting to something that they haven't really communicated to the market?
I believe that inside the Fed, and I talked to some low-level Fed employees a lot, within the Fed, the bias was not to cut the interest rate. The Fed believes that they're the only institution in the U.S. government that stands between us and the destruction of the purchasing power of the U.S. dollar. They don't see the executive, they don't see Congress having any fiscal discipline at all. And the bias within the Fed was not to cut, but the political pressure, particularly at the top of the Fed, was too strong. So they cut. But the macro environment, Tom, goes much, much, much beyond the Fed. Unfortunately, the question you asked requires a fairly long answer, so buckle your seatbelt. Here goes. In my lifetime, precious metals have moved because investors have had nervousness about the maintenance of their purchasing power, the purchasing power of their savings or salaries in fiat currency instruments. And I think that the circumstances in front of us will cause people to be more and more concerned. Let's look at the causes of concern and let's talk about the arithmetic so that your listeners can punch holes in my arguments if they can see them. The first is on-balance sheet liabilities. The US government, and I'm not speaking to the Canadian circumstance right now, the US government owes bondholders just about $36 trillion. Let's be conservative and call it $35 trillion. To put that in perspective, it's 120% of GDP. During, as an example, as recently as the global financial crisis in 2008, the corresponding number was 35 or 36% of GDP, not 120% of GDP. That's important because it limits options. But much scarier, Tom, is the net present value of unfunded off-balance sheet liabilities, things like Medicare, Medicaid, Social Security, federal government pensions, military trust fund, that kind of thing. That number is now estimated to exceed $100 trillion. That's not the nominal value, that's the net present value. Now, the on-balance sheet liabilities of the US government increase rather than decrease by $2 trillion a year. Putting that $2 trillion in perspective, and this is really truly staggering, gross government income is $4.4 trillion a year. So the debt increases by 50% of total net government revenues every year. But it gets worse. Those off-balance sheet liabilities, that $100 trillion I talked to you about, is estimated to be increasing by between $2 and $4 trillion a year. So in aggregate, the US government is upside down $135 trillion a year. And by conservative estimates, that hole, that debt, is increasing by $4 trillion a year. The Federal Reserve estimates that the total private wealth in the United States, not including the value of federal land, which is unlikely to be sold, the total private wealth in the United States is just under $140 trillion. If you add the off-balance sheets and the on-balance sheet liabilities of the US government at $135 trillion against the net worth of private Americans at $140 trillion, you begin to see the problem. The truth is that there is no way at all, ever, arithmetically, that we can deal with this. We were faced with a circumstance that was similar, but not as severe, at the end of the decade of the 1960s. And the political solution to the problem then was, I believe, the same as the political solution to the problem will be this time. According to the US government, in the period 1970 to 1980, we inflated away over 75% of the purchasing power of the US dollar. That's how we'll solve the problem. Old codgers like me, who were promised, say, $2,500 a month in Social Security, will get $2,500. But the $2,500 that they get will buy $300 or $400 worth of goods and services by the end of the decade. We will inflate away the obligation, just like we did in the 1970s. Now, relating this back to gold and silver, in the period 1970 to 1981, while we inflated away 75 to 80% of the purchasing power of the US dollar, the gold price went from $35 an ounce to $850 an ounce. Let's be conservative again, and let's say that it was only at $35 because it had been price controlled for years. Let's assume that the free market price of gold in 1970 would have been $100. So the gold price only went from $100 to $850. Fast forward again to the last time that there was concern about the purchasing power of the US dollar, the year 2000. In the period 2000 to 2010, the gold price rose, albeit by a much more modest number. It only went from $253 an ounce to $1,700 an ounce, a seven-fold increase. If I'm correct about the way our society proposes to deal with $135 trillion in debt, which is to say, inflates away the net present value of that obligation. And if, like in the 1970s, the purchasing power of the US dollar declines by 75%, I would expect a substantial rise in the gold price. When people, including your listeners, Tom, have asked me in the past, when is the gold price going to move? I say, 2000. From 2000 to now, it's moved from $253 to $2,700. That's over 8% compounded, which is to say that gold has maintained its purchasing power for 24 years. My belief is, unfortunately, that the rate of deterioration of US dollar purchasing power is going to increase. And as a consequence of that, the gold price is going to increase in almost commensurate fashion. I hope, unfortunately, I answered your question, and I would dearly love to be wrong.
Well, you and I have talked about things that could change your mind before. And it seems like I think we visited that maybe 3 years ago, and we're only further down that path. There doesn't seem to be any hope. Maybe I'm wrong, but any hope or suggestion by either party going into this election that shows us any different.
Some of the Trump supporters have expressed hope that Elon Musk is going to cut federal government expenditures by 80%. I think it would be lovely. I would refer people who hold out hope for the political system to a wonderful book by David Stockman, who was the director of the Office of Management and Budget under Ronald Reagan. It's called The Triumph of Politics, and it describes the political reality of cutting government expenditure. David Stockman, amusingly, his educational background to become the head of the Office of Management and Budget was that he was a divinity student. And he said that turned out to be very appropriate because he prayed every day. But at any rate, people who hold out help for political reform, I think, owe it to themselves to read The Triumph of Politics by Stockman.
Rick, I recently spoke with Judy Shelton, and we explored the idea of backing treasuries with gold. Do you think that this is a useful idea or step into returning to some type of a constraint to government spending, or does this end up making the debt more attractive to buy, ultimately giving government more access to debtors?
I think it's a wonderful dream. And I think it's just that. People, if you tie government expenditures and government borrowing to gold, if you don't allow Congress to print, you strip them of their ability to bribe voters and to reward their friends. You reduce their power. In your lifetime, Tom, have you ever been confronted by a politician who was looking to constrain his or her power? The idea that they would constrain their power by tying their expenditures to reality, to gold, the probability of that is nil.
Unfortunately, Rick, I will say that I think I have been exposed to maybe a small handful of politicians that have said something like that, but the issue becomes their actual electable or the size of their possible electorate. I don't think that most people are going to be voting for something like that.
Right.
So,
yeah, I guess if you looked at all of Congress, I should have exempted Ron Paul. 1 out of 530. So I stand corrected, Tom. You're right.
That's why I said it was a small handful, unfortunately. So, Rick, now that we have this macro backdrop, and of course we only spoke about the US, but it's not like, there's a shining example of a country that is really changing things out there. Now that we have that backdrop in our minds, who takes leadership at the beginning of a gold bull market?
In my experience, gold bull markets are led by physical gold. And I think in the last 18 months, we've seen the physical gold price has done well in US dollars, even as the US dollar has done well in other currencies. The gold price escalation that Americans have seen is less and later than the gold price escalation that virtually everybody else in the world, including Canadians, has seen in their own currency. And I think that's important. Traditionally, physical gold leads. Then, as the increase in the gold price begins to increase the free cash margins of gold mining companies, the biggest and the best gold mining companies come next. The moves that we've seen, as an example, in Wheaton Precious and Agnico Eagle in the last 4 years the last year, the 40% move in the last 12 months, suggests to us that we are just beginning to see the escalation in the biggest and the best mining companies as a consequence of the gold price increase. That's why I say that the next 1 or 2 quarterly earnings reports are so critical. If we see a follow through in free cash flow as a consequence of higher gold prices, I think that you'll see renewed vigor among the senior miners, both from the traditional gold community, but also from the generalist investor. What has happened in the past then is that the best of the best, the senior producers, have enjoyed disproportionately large increases in their share prices and market caps. And some investors look for relative value. They go to the second tier producers or they go to the developers. And the second tier developers or producers who don't experience increases in share prices get taken over by the majors. Those people who have a lower cost of capital have a decided competitive advantage in a capital intensive business like mining. So if the market doesn't arbitrage out the respective valuations, you see M&A, and you're beginning to see M&A in the sector now. A couple interesting things happen after that. One is that sort of halfway through a market cycle, when the generalist investors are attracted to the precious metals narrative, with momentum having been established by gold, when they come into the market, silver takes over leadership. I'm not sure why. Maybe they're attracted to its historic volatility. Maybe the lower unit price. I don't know why. I just know that at a certain point in time, leadership changes from gold to silver. Silver then, having started later, moves much further and much faster. In that period, equity leadership changes from the biggest and the best of the golds to the junior producers, the developers, and of course the penny dreadfuls. Interestingly, at that point in time, often the worst companies do the best because they exhibit the highest leverage to the gold price. The silliest moves of all are in those few high-quality silver companies. Now, it may be that there's so much liquidity in the system now that the traditional market response has been disjointed. You probably recall an interview that you and I did in November or December of last year when I described the silver juniors as a coiled spring. The reason I did that is they were so hated. And the moves that we've seen in names like, Abra Silver, Vizsla Silver, Aya Silver, I think have as much to do with the dead cat bounce as anything else. But it could be that this time the market will be more speculative because I've been astonished by the strength in the high quality junior silvers, which usually move last in the cycle. Mm-hmm. The fact that the best of the best, the Wheaton Precious, the Agnicos, are up 35 to 40%, while a basket of the high quality juniors is up by 200%, makes one wonder whether past will be prologue or whether this market will be front-ended by speculation as opposed to rear-ended by speculation. And I don't know the answer to that, to be honest with you.
Maybe another idea we can put forth to explain that, Rick, is this rise of cryptocurrencies and this risk appetite, or let's say maybe risk averse type of investor that is looking for these outsized returns and possibilities of returns. Do you think that might have something to do with it, Rick?
It could. I mean, there is a whole generation of investors who gets information differently. Mm-hmm. In prior bull markets, the narrative had to come down to the investment banks and the brokers and the mainstream financial press, the Wall Street journals and the Fortunes of the world, before it found its way to Main Street. Mm-hmm. Now, there's 500 independent journalists, guys like Tom, as an example. And there is broader access to information, faster, disintermediated information. It could be that because of disintermediated information, and because increasingly interest in investments is bottom up as opposed to top down, that new instruments like junior silver stocks or like cryptocurrencies gain favor and circulation quicker. I don't know. Mm-hmm. Likely the truth will be known after I've shed my mortal coil. I'm 71, but mm-hmm. It's interesting to speculate on.
So we're going back to this idea that physical gold kind of starts that bull market. I've spoken to and seen a number of anecdotal tweets recently from different people that have seen demand from retail bullion dealers in Canada and the US as being really low, and dealers seeing more selling back of bullion than buying. So do you see this as a positive indicator for being early in the bull market, or is it possible that they're missing the demand that is coming from the rest of the world?
Mostly bullish, but let's do a deep dive. The move that we've seen in gold is not due to retail. It has been due in the last 3 years to foreign central bank buying. One of the reasons why the gold stocks haven't moved while gold has moved is because the buyer has been foreign central banks, and they don't buy stocks, they buy gold. Mm-hmm. If a buyer is present in one market and not in another, it would make sense that the market that they were present in moves, not the other market. If you judge retail interest in North America, not by anecdote from the dealers, but rather by statistics, looking at the inflows and outflows of funds from physical ETFs like GLD, you will see that the retail buyer was a net seller of physical precious metals until 20 weeks ago. The Western European and the North American, the developed nation retail, has not been in the gold trade until 20 weeks ago. Mm-hmm. Now, I will say that part of the weakness experienced by the physical dealers and the coin dealers has to do with the fact that there's a bunch of other ways to buy gold now. You can buy it in the form of an ETF, GLD. I would prefer it, of course, if you bought it in the form of the Sprott Physical Gold Trust or the Sprott Physical Silver Trust. But that's another $30 billion pool of capital that, in effect, came out of the dealers. You can buy it at Costco. If you measure purchases and sales of gold not from the traditional retail dealers, but rather you include new entries to the market, like Costco, you see a fairly different picture. And I think we're just beginning to see retail demand. The biggest inflows that I have seen into the physical ETFs, in particular GLD and SLV, occurred last week. That would give one some sense that retail participation is increasing and increasing at a faster pace.
I got an email from a listener the other day telling me about what he saw when he was at a Costco, and he said that all of the physical silver was sold out, and there were kind of, let's say, a handful of gold bars and coins left. So it's interesting to see that pick up, especially at somewhere that is, not necessarily known for selling physical gold or silver.
That's correct. I think they've addressed a market well, and to their credit, when Costco moves into a market, they're pretty efficient. I'm delighted not to be a physical gold dealer anywhere in the vicinity of a Costco.
Mm-hmm. So, Rick, how would you separate, let's say, different types of investors that should be looking at the gold mining space? Should we separate by age and income levels? How do you kind of build those baskets in your mind?
That's a great question, Tom. As you know, I've graded tens of thousands of portfolios personally for a very long time. And I've come to learn a lot about the way people invest. I would say it's important for investors, first of all, to know themselves. That's the most important thing. For most people, they should start a gold portfolio by owning gold, owning physical gold. And I wouldn't own it for investment purposes. I would own it for insurance purposes. I'm relatively convinced that gold will maintain its purchasing power, even as other mediums of exchange or stores of value lose theirs. The second stage is to build an investment portfolio. Buy the beta in the gold market. What has struck me about prior gold bull markets is that the market beta, which I define as the outperformance of gold shares relative to the broad market, is often substantial enough that people don't need to own the juniors at all. If you can get 200 or 300% beta in the best of the best over 3 years, 4 years, 5 years, that's pretty good. 300% in 5 years, particularly when so many of your neighbors will be losing money hand over fist. Your relative gains will be attractive. Mm-hmm. For people who can afford psychologically and financially to take more risk, there are very few speculations that exhibit the size of upside that can be delivered from a speculative gold portfolio. I've noticed two problems in grading tens of thousands of portfolios. The first is that while most people describe themselves as fairly conservative investors, they act like wild speculators. There's nothing wrong with being a speculator if you're being self-honest. But if you aren't able to take, as an example, 15% volatility, if you aren't willing to risk 35% absolute loss, you shouldn't speculate. Mm-hmm. You should invest. The second thing is that speculation involves the probability of some loss if you don't do the work. I would suggest to you, Tom, that probably 85% of the junior mining listings at any point in time are valueless. Valueless, which means that you stand a chance of making money on 15% of the issues. Mm-hmm. If you don't understand, first of all, how to separate the wheat from the chaff, you will certainly lose. But even learning how to do it, if you don't do it, you will lose. And that comes to the second failing I observe in people's portfolios. Most speculators own many too many stocks. It is common that I will review a portfolio where the speculator owns 50 or 60 stocks. Mm-hmm. I suggest to speculators in my courses that the number of stocks a speculator should own should correspond to the number of hours per month that he or she is willing to spend studying their stocks. And by studying, I don't mean listening to videos, although I encourage that activity too. I mean reading annual reports, reading quarterly reports, reading analyst studies, reading insider filing statements, reading resource statements. If you are reasonably willing and able to spend 10 hours per month, you should confine the number of speculative stocks in your portfolio to 10. My belief is that if people were self-honest about whether or not they were investors or speculators, and how much of each they were, and organized their portfolio to correspond with the amount of risk they were actually willing to take, and if they were willing to limit their speculative exposure to the number of companies that corresponded with the number of hours per month that they were willing to work on their portfolios, that the performance of those portfolios would have been dramatically higher.
Well, I think over that study, you really get to develop a sense of where the company is headed and what they're actually doing, if they're following their roadmap, what have you. And I think that's extremely important. And it's not only that, but it's also the idea that you're taking a little bit of time to study some of the comparables that maybe you had your eye on to really get a sense of what should be happening, right?
Tom, in the junior stocks, even just a study of management track record, have they been successful in the past? And does the success that they've enjoyed relate to the task at hand? Just doing that would probably improve portfolio performance by half. Just doing that. In fact, it would improve my own portfolio. I think I've told you before, if post age 35, I hadn't invested with anybody who hadn't made me serious money by the age of 35. In other words, if I had confined my portfolio to people who were already serially successful by the time I was 35, I would have made twice as much money and worked half as hard, which is a pretty good offer.
So, Rick, would you take political or jurisdictional risk over technical or geological risk?
No. I mean, let me put it differently. I would accept political risk more easily than I would technical risk. I have found that through bitter experience, the most dangerous government is the one closest to me. My worst financial experience with political risk was in the People's Republic of California, a state that I lived in at the time I experienced the risk. You would think that I understood the risks. Subtext: never try to build a gold mine in a place where they spell shop, SHOPPE. When I look at jurisdictions around the world where I've made a lot of money in versus money out, the list is surprising. The best for me is Chile. But the highest return for me was Congo. The third highest, I think, was South Sudan. The truth is that I have done very well taking political risk in return for owning truly spectacular deposits at huge discounts to what other people who perceived political risks differently than I took. You know, in Canada, Alberta is widely regarded as a riskless jurisdiction. You'll remember that it was a conservative government in Canada that ended the preferential tax treatment for income trusts. You'll recall in Alberta when 15, 20 years ago, the natural gas price doubled, that they doubled the provincial royalty. That's de facto partial nationalization. This will get you a lot of hate, Tom. But the truth is that people that look like you and I believe that money stolen from us by white people in English, according to the rule of law, is less gone than when it's taken by means that we understand less and by people who have different complexions than we do. But the truth is that the arithmetic is the same.
Yeah, a loss is a loss. A theft by any means is still a theft.
That's correct.
So, Rick, taking a couple of these examples, let's say let's say we take two examples of different investors. How would you suggest that they gain some exposure to the metals or the metals industry. So obviously we're starting with physical gold. I've heard you say that you would choose royalties and streaming deals over anything else. So, going to that example that you kind of touched on in your last answer of something already being priced in to the price of a stock, because of the, let's say, lesser risk and lesser cost profile of some of these royalty and streaming companies, does that also lessen their upside because that's already priced into their share price?
What lessens their upside is perverse. The fact that they have very high operating margins means that they have less leverage to the price of gold. Think about a company that produces gold, let's keep the math simple, for $1,700 an ounce. Right now, they're making $1,000 an ounce. An inefficient company that produces gold for $2,000 an ounce is making $700 an ounce. If the gold price goes up by $1,000, the more efficient company doubles their margin, and the less efficient company triples their margin. In the later stages of the gold bull market, the worst companies do the best because they have the most leverage. And when I was a young man, I chased that alpha. As an old man, I've come to believe that if you take away most of my downside, you can take away some of my upside. So I tend to err on the less leveraged, higher quality side, trying to capture as much beta as I can. I do because I work hard and because I have access to a lot of knowledge that I can buy or borrow from other people that I know. Also devote 20 or 25% of my portfolio to speculation. I'm a good speculator. Whether or not other people who have less access to talent and less psychological tolerance for risk probably should limit their speculation.
Rick, if we go back and think about some of your biggest wins over the years, do they have something in common? Do they have maybe a known management team, as we touched on already? Do they have maybe some type of informational advantage, as you just touched on? What is one thing that maybe ties them together?
Yes, yes, and yes. You never make money on a small deposit. So entrepreneurs in particular are seduced by a story that says a company is going to put a small deposit in production and use the cash flow from that to grow without diluting. It's a wonderful story, but it doesn't work. Worked 4 or 5 times in my career, probably. Small mines and big mines have big risks, but only big mines can make you big money. So where I have made money has really been on tier 1 deposits with a minimum value of in situ recoverable reserves and resources at today's commodity prices exceeding 10 million ounces, $10 billion. So say a 4 or 5 million ounce gold deposit, larger being better. The second thing is that I have made money by people who have already been successful, often serially successful. I haven't always known them from their past successes, but I have always been able to check out their reputation in the industry and look at their curriculum vitae and see not only have they already demonstrated success, but the success that they demonstrate is appropriate to the task at hand. If somebody was successful building, or let's say operating a gold mine in Archean 2 billion year old terrain in French-speaking Quebec, and they're proposing now to explore for, rather than operate, a copper gold deposit in 15 million year old accreted terrain in Spanish-speaking Peru, while they have been a success, the success isn't necessarily appropriate to the task at hand. So I look for materiality. I look for successful people. And then I look at process. What is their unique competitive advantage? Is their analysis of the exploration potential of a project predicated on the fact at hand, or does it just make a good story? Does their thesis to test, does their proposal, their plan to test the thesis make sense? Will it accomplish what they're about? Very, very, very often, if you just apply those three common sense screens, you can avoid error. Mm-hmm. And avoiding error is how you have enough money, enough time, and enough courage left over to succeed. When I look back at where one more thing. You have to be a contrarian. You have to be involved in activities that are out of favor when you do them. When I look back to my my biggest score of all, percentage-wise at least, it was Paladin back in 1998. Uranium. Everybody hated uranium, so I had no competition. Paladin, at the time I discovered it, had a 1.8 million Australian dollar market cap, 1.5 million US. I mean, figuratively, it was a gumball. Mm-hmm. The guy who was behind it, John Borshoff, I didn't know, but as I researched him, I found out that he was highly, highly, highly respected in the uranium business. Plan, durable competitive advantage. I asked him at the beginning of the relationship, John, how, with a $1.8 million market cap, can you afford to explore for uranium? You can't even keep the doors open. He said, Rick, I don't have to explore. I said, I got to hear this. He said, well, in a prior life, I ran the worldwide exploration business for the biggest West German state-funded uranium fund. And I spent $1 billion of their dollars exploring for uranium worldwide. When they shut the company down, I took the database as my severance. So I don't have to explore. All I have to do is stake the stuff I already discovered, spending $1 billion from the West German government. The best answer I ever heard in my life.
No kidding.
That stock went from 10 cents to $10 in 7 years. It did go from 10 cents to 1 cent first. And that's a different lesson. You have to be persistent and tenacious and risk tolerance. I look at other successes I've had. I'm talking now about the importance of people scale and importantly, contrarianism. In 1995 or 1996, there was a civil war in Congo where 2 million people died. So clearly, people were attracted to the Congo. And the copper price was in the toilet too. There was a company called Tenke Mining, Tenke, that controlled what was then the largest and highest grade undeveloped copper deposit in the world, Tenke Fungurume. The management team, the Lundins, my favorite of all managers, because Congo was out of favor and copper was out of favor, Tenke Mining at its bottom had a 19-cent share price when it had 30 cents a share in cash in the company. The best copper deposit in the world, run by my favorite management team, was selling at a discount to cash. Now, only two things can happen. Because of the Civil War, you could lose all your money in that, or else the stock was going to go materially higher. In my mind, the juxtaposition was 19 cents. I could lose everything I had, or over 5 years, the stock could go to $5. I was wrong. It went from 19 cents to $19. What did I do? Took contrarian risk on copper, on Congo, bet on a management team, and of course, scale. The biggest undeveloped copper deposit in the world at that time. There are lessons there. They're repeatable.
Rick, you just touched on, let's say, the framework of an excellent lesson, I think, and a question that I'd like to ask you. When entering into an investment or a speculation of this nature, do you try to put some type of time frame around when you expect some type of material success, and do you leave the door open to changing that?
Well, the first question, I back tested my 10 baggers for 35 years, at least those I remember.
Mhm.
And what was common is that it took in excess of 5 years to enjoy a tenfold return. Most people who invest in natural resources buy them on a long-term narrative. If you believe that the copper price is going to go up over 5 years, but you have trauma holding a copper stock over a long weekend, applying a 3-month tactic to a 5-year narrative almost guarantees you're going to be wrong.
Mhm.
The eighth wonder of the world, but the first wonder of finance is compounding. And compounding takes time.
Mhm.
If you don't have the attitude that time is going to be on your side, you will not win. You will lose. It's a guarantee.
Mhm.
Very few guarantees in finance. So I anticipate that value will be added by answering a series of unanswered questions. It might be around a commodity. It might be around exploration. It might be around tweaking process, but that's going to take time. Even in the exploration phase, Tom, I assume that I'm going to have to answer one or two unanswered questions. Let's assume that there's a good surface anomaly that's backed up by trend samples. Now it needs to be drilled. That's going to take at least one drilling season. And then that drilling, if it's successful, is going to need to be delineated. That's another drilling season. So to get two unanswered questions, maybe a double and then a double, a four-bagger, is likely at best going to take me 2 years.
Mhm.
And during those 2 years, I'm unlikely to be troubled by things like tax loss selling or the presidential election cycle. Or some newsletter writer or some institution changing their mind.
Mhm.
I'm much more inclined to be encouraged or discouraged by data. You asked me too if I change my mind. Absolutely, positively. If I own a stock for a reason and the reason turns out not to be true, I sell the stock. If I bought a dollar stock because I think the outcome of a 10-hole drilling campaign will generate enough information that the stock will be worth 2 as opposed to 1.
Mhm.
And I get back the results in the first 5 drill holes and they're lousy, understanding that most guys don't drill their worst holes first, I'm likely to sell the stock. If it's at 70 cents, I sell it. If it's at 50 cents, I sell it. Most people have this perverse sense that they're going to hold the stock till they break even. Why would it break even? So it's important when your thesis is wrong that you admit it and you sell. Similarly, it's important that you react to good news, especially good news that's accompanied by a share price decline, by aggressive purchasing. If I learned anything from my long partnership with Eric Sprott, it's don't be afraid to be right. When you have a bet and the bet is decidedly in your favor, understand that the markets can often be wrong in the near term. Buffett famously said, the near term markets are voting machines. In the long term, markets are weighing machines. And I think that explains it very, very, very well. If you have a circumstance where you've really, truly done the work and your thesis is playing out correctly, and particularly where the stock declines in price, you need to be an aggressive buyer.
Rick, there's recently been some pretty big M&A deals in this space. Do you think that this is a sign of things heating up in the bull market as a whole when larger companies are starting to allocate capital to replace their ounces or their lifetimes?
I do, and I think it's good for the market too. M&A is great. It adds hope and liquidity in a sector that until recently has had none. But probably more importantly, let's say a multi-asset producer is regarded rightly as less risky than a single asset producer. If a single asset producer, something goes wrong for a while, you're in real trouble. Multi-asset producer, you have other assets to fall back on. And the consequence of that is that multi-asset producers have a lower cost of capital, a higher share price. You can solve that problem for the single asset producer easily. Sell it to the multi-asset producer. You lower the cost of capital in a capital-intensive business. Lowered cost of capital is good for everybody. Another thing that happens, at least in well-constructed M&A, is that general and administrative expense relative to assets under administration fall. One management team looks after two asset packages. Very, very good thing. And capital allocation decisions that are made across a multiplicity of assets are often better than asset allocation decisions made on one asset, where the management team has to develop the asset to keep getting paid a salary. So yes, this M&A activity is partially a function of the sector heating up, but it's also a factor in the sector heating up.
So is this only really a one-way street where bigger companies swallow smaller companies, or is there also a place right now for larger companies to be divesting themselves of, let's say, tier 2 assets and focusing, as you say, their love, care, and attention on their tier 1 assets?
Great point. Yes and yes. An example is the persistently high all-in sustaining costs being suffered by Newmont. Newmont knows what they have to do. After Newcrest, they were left with, 12 or 15 tier 2 deposits. Newmont needs to sell those deposits to companies that will focus their love, care, and attention on those assets rather than have them as distractions. Use the proceeds to strengthen their balance sheet and focus their own attention on the remaining tier 1 deposits. Make the balance sheet better, lower the all-in sustaining costs, and also give management teams that are willing to focus the ability to make something out of a 1 million ounce deposit that wouldn't matter to Newmont. It's a really good circumstance. And there are teams in the market, you've seen them, that have the ability to buy a neglected tier 2 asset that has been starved for cash or milked for cash, that hasn't had sustaining capital investment made on it, that hasn't seen a pair of fresh eyes for a long time, that will perform much, much, much better with a smaller company.
That idea that there is different management teams for different stages, I think is a really interesting point, Rick. And we don't need to spend too much time on this, but as a company moves through its life cycle from, let's say, an explorer to a junior to a major, do you think that those are three distinct phases that require three distinctly different CEOs with different skill sets?
Mostly, yes. There are some managers in the sector who are self-honest enough that they change managements as they go. I'm thinking about Robert Friedland's ability to hire an explorationist as CEO of an exploration company, replace that CEO and CFO with a mine builder, and ultimately replace that person with a manager. I've watched the Lundins do the same thing. I've watched Ross Beatty do the same thing. I look at my own career. There was a point in time building my business where I was a great sole proprietor. The business got big enough that I came to understand that I was spending too much time running the business and not enough time looking after my customers. I wasn't able to do securities analysis because I was too busy running a brokerage firm. So I fired myself and I hired a CEO. There came a point in time when that business got big enough that I felt that it needed to be merged into a bigger financial services platform. So rather than then hiring a manager, I sold the business to Sprott, put it under the stewardship of Eric Sprott and Peter Grosskopf. The same circumstance that you described with the junior miner actually happened in my own estimation with my own business. Because I was the only shareholder, I saw, to my chagrin, at a certain point in time, that I had become a bad CEO relative to the task at hand, and I was able to fire myself. So I think what you say is true.
Yeah,
there have been, but they're rare, people who were able to manage all of those transitions. I think of Roy Fang as an example at Silvercorp, taking it from a silver explorer in China to a multi-asset mining company internationally. But maybe the exceptions prove the rule.
So, Rick, we've talked a lot about how this cycle develops. And if you look at a chart, the amount of CapEx that has been spent within the mining industry on exploration for the last several, almost decade has just been down and to the right. It's almost nothing at this point. When do you think CapEx moves back into the exploration space in a meaningful way?
I think we're at least 2 years away. Right now, I think it is still cheaper to buy successful efforts. Mm-hmm. It's a really open question with the juniors, Tom, because the juniors are, as a class, an inefficient way to explore. If you looked at the aggregate expenditures every year by the junior industry relative to the economic value that they generate through discovery and M&A, you'll see that the juniors as a class destroy capital. In a very good year, they would probably only lose, by my definition, $2 billion. Mm-hmm. In a bad year, perversely good for them because they can raise the money, they'd lose $10 billion.
Yeah.
Now, one of the reasons is structurally very high general and administrative expense. Many years ago, we did a study, admittedly only 25 companies, but the median company in our sample spent over 60% of capital raised on G&A. Only 40% went in the ground. You can understand how capital inefficient that is. Mm-hmm. It probably makes sense for the major mining companies, in the rare case where a junior really truly makes it a tier one discovery, a Great Bear discovery, an Arequipa discovery, to pay up and buy it. Yes, the major could make that discovery themselves, but it may take them 15 or 20 years. The successful effort, and particularly the net present value of being able to accelerate that process by buying the deposit as opposed to taking the chance and the time value of money to find the deposit, means that we will continue as long as there are deposits left to buy in the junior space. We will be in a circumstance where M&A is likely more important than exploration. The other thing is that there are some organizations where exploration is in their DNA. Look at Robert Friedland, one individual. Now, he hasn't made the discoveries, but he's caused them to be made. Mm-hmm. Going back in my memory, Fort Knox, 10 million ounce gold discovery. Gross Rosebell, 6 million ounce gold discovery. What came next? Voisey's Bay, the $5.8 billion takeover in the nickel business. Oyu Tolgoi, one of the 10 biggest copper gold mines in the world. Mm-hmm. Kamoa-Kakula, the most important by grade gold copper discovery in the last 50 or 60 years. And then, of course, it's not in production yet, but the Platte Reef, 75 million contained ounces of platinum and palladium. This is one guy running teams that's had 6 tier one discoveries. Mm-hmm. Nobody can touch that. Rio Tinto can't touch it. Nobody can touch it. So maybe corporate strategy comes to be governed by the board of directors' own assessment of their team's competency and DNA. Mm-hmm.
Rick, is there any particular jurisdictions or, let's say, sectors that are particularly attractive to you right now? We've gone through times in the uranium industry, the energy industry, where they've had some rises here. We've gone through a little bit in the gold and silver industry. And because of that backdrop, do you think that it kind of brings you back to being excited about the gold and silver industry again?
I am excited about the gold and silver industry simply because I'm excited about what I believe to be the inevitability of the gold price rise.
Mhm.
The arithmetic that we discussed early in this interview, I think, is inescapable. I think we reduced the purchasing power of the US dollar by 75% over 10 years. And I think, unfortunately, that's very good for gold. So I'm excited about that. I don't think that gold is out of favor.
Mhm.
So it's not a contrarian activity. But really, gold is ignored. We've talked before, Tom, and this stat hasn't changed. The market share of precious metals and precious metals related securities relative to other savings and investment asset classes in the United States is less than 1/2 of 1%,
Mhm.
which is to say that 1/2 of 1% of all savings and investment assets in the United States is denominated in precious metals or precious metals related securities. The 4-decade mean market share is 2%. Gold doesn't have to win the war against the US dollar. Gold doesn't have to win the war against US Treasuries. All gold has to do is revert to mean,
Mhm.
and we get a 4-fold increase in demand. You know what a 4-fold increase in demand does to price. That's what's going to happen, I think.
Mhm.
But there are other circumstances where, while I don't have the same certainties of the commodity price, I feel better as a speculator. One would be North American natural gas, particularly Canadian natural gas. If you would have asked me 2 years ago, I would have said that the condition precedent for Canadian natural gas to work would be Canadian voters thanking and excusing the Prime Minister. And while from the point of view of natural gas markets that would help, the truth is that there has been enough investment in gas transmission and liquefaction in Canada, particularly in the West, that the situation is going to begin to solve itself anyway.
Mhm.
An election could speed it up depending on the outcome. But the numbers around Canadian natural gas are just so compelling. The Alberta gate price is about $1.50 Canadian, the AECO price per million BTU.
Mhm.
That same gas landed in Shanghai or Rotterdam or Tokyo sells for 10 Canadian dollars. And it costs 2.5 Canadian dollars to get it there.
Mhm.
Transmission, liquefaction, shipping, deliquefaction. So a $4 product that sells for 10, 60% operating margin. Your prime minister said that he can't see the business case in. I wish he'd let me explain it to him. It's really pretty simple math. And my suspicion is that that market opportunity is bigger than the prime minister and will resolve itself. So for contrarian pick, I love North American natural gas, but particularly Canadian natural gas. What else is out of favor? Well, I'll tell you one that's coming into being as out of favor as uranium was, and that's lithium.
Mhm.
Lithium was the investor's darling 5 years ago. Billions of dollars went into your lithium exploration,
Mhm.
and we found a ton of it. The truth is that we were never short of lithium, though. We were short of lithium process capacity. And over 6 years, those bottlenecks get erased. So the lithium price, which went up 5 or 6-fold, is now off by 75%. And of the probably 150 deposits that we found worldwide, probably 8 or 10 are viable. I think over the next 2 years, the hate expressed by the lithium speculators who bought into the narrative will be as extreme as the hate that was expressed towards uranium. And I think that'll happen just as the lithium price is bottoming.
Mhm.
And as those 8 or 10 good deposits get bought by the real players. So I suspect if you and I are having an interview in 2026, what I'll be saying to you is, Tom, I'm going all in lithium
Mhm.
when the hate is the most extreme. What else is hated? Rare earths are hated. Sulfide nickel is hated. Platinum group metals are hated. So what am I doing? I'm looking for potential tier 1 deposits in rare earths, sulfide nickel, platinum group metals that don't have to worry about today's low prices because they're at the advanced exploration stage, where I have to worry about markets 5 years from now. deposits that are large enough that major multinational mining companies will have to own them. Deposits that'll be in the bottom cost quartile worldwide and the best quartile worldwide in their commodity in return on capital employed. And I'm buying as much of that kind of stuff as I can, understanding that I'll need to own it for 5 years, but understanding too that the highest probability of my getting a 10-bagger, particularly at my now advanced age, is by buying tier one deposits that other people hate and be willing to own them for 5 years for my thesis to come true. Mm-hmm. And this is a uniquely good time to do that.
Rick, when companies offer private placements in order to be able to finance or raise money, does that necessarily make you shy away from them because of their cost of raising capital and their share dilution? Or if you see that it's being used in an intelligent way, does that attract you?
Very much the latter. Remember, there's no capital as expensive as not having any. A company that runs out of money goes to zero, mm-hmm. and that's pretty ugly dilution. If a company comes to me with $100 million market cap and they want to issue 10% of themselves, $10 million, and that $10 million has a reasonable possibility of making the company worth $200 or $300 million, I'm on it like white on rice. Mm-hmm. What turns me off is when a company wants to dilute 10% of themselves, and I say to them, so in terms of this $10 million that you're going to spend, tell me the most important unanswered question that $10 million is going to answer. And tell me how you developed the thesis and how you propose to test it. Over 45 years, asking management teams to define the unanswered question, probably 80% of them didn't have an answer for me. Their real unanswered question is, will I have a salary in 18 months? And while I can understand that that's of interest to them, it's not of interest to me. Mm-hmm. But if somebody comes to me with a great value proposition, answering an unanswered question, when I understand that they're diluting themselves by 10%, but there's a 25% chance that 10% dilution could result in a 200 or 300% share price escalation, I've got a lot of interest. Mm-hmm.
Rick, as you think about your career over the years here, again, you have this great perspective of this long-term ability to review being involved in this sector for so long. What are some psychological lessons that you learned, maybe as a trader, maybe identifying times where your psychology was wrong and you took that and internalized that lesson and moved forward in a positive way from that?
Well, I would say contrarianism is the most important. Learning the markets work. Mm-hmm. I've recounted interviews with you before that I came of age in the decade of the 70s, the most aggressive bull market of all times. And I conflated my investment success mm-hmm. with my brains. When that market went south, I found out just how smart I was, which is to say not very. Mm-hmm. But I also learned that markets work. The cure for high prices is high prices, and the cure for low prices is low prices. Most investors, when they look at a narrative, don't believe it until the price of the commodity has already moved. Nobody wanted to buy uranium stocks at $20 uranium, and everybody wanted to buy them at $100 uranium. How's that going to work out for them? The $100 uranium proved the thesis, but all the value was out of it because the move had already occurred. Mm-hmm. So that's important. The second is patience. We've talked about that before. People buy a 5-year narrative with a 3-month fuse. How's that going to work? I mean, I wish that I could get 10 baggers in 3 months, but my wishes aren't relevant. I guess the third is, and I always knew this, but I didn't always employ it. If you had a theory about value, you came to understand price. Money is made on the delta between price and value. Price information is easy to get. You get it online. And you believe that you spend price, but you don't. You spend value. If you have an opinion as to value, and you have an opinion as to how a company can add value, then you put the price in context. But having price information without having an opinion as to value is useless, probably counterproductive. Money's made on the delta between price and value, and the delta between price and expected value. If you have an opinion as to value, that allows you to endure volatility. Penny shares in particular can fall 15% because some institutional investor gets a redemption. Has nothing to do with the company, has nothing to do with the commodity, has nothing to do with the market, has nothing to do with anything. If you aren't able psychologically to stomach 15% volatility without calling your thesis into question, you're going to get bashed out at market lows and bought in at market highs. It's just not going to work for you. Mm-hmm. So you need to do the work to establish at least a theory of value. The fourth would be that most people do too much, particularly after they've made money. You know, if somebody's bought a stock at $1 and they sold it at $7, they think, okay, I finally got this sector figured out. And by the way, it's a good sector. And then they're in a rush to put that $7 to work. And if they're in a rush, they usually turn it back into $1. There are times in the market where the market doesn't give you anything to do. And when the market doesn't give you anything to do, you're pretty wise not to do anything. My friend Jimmy Rogers once said that once he learned the lesson, he's made most of his money by sitting in the corner of a room doing nothing, crossword puzzles or whatever. And every now and then somebody seems to walk into the middle of the room with a big bag of money and leave. And his job is to recognize that somebody walked in the room with a big bag of money, go over, pick up the bag of money, and go back in his corner and sit there until somebody brings another bag. And I mean, Buffett said the same thing. He said, if the market doesn't give you anything to do, don't do anything. So I think those are all important lessons.
Very. Rick, I want to thank you very much for sharing your wisdom and your lessons here with us today. Let our listeners know about any of the offerings that you have currently, and as I'm sure, helping them review their natural resource portfolios as well, right?
Yeah, my easiest offer, because it's free, no obligations, and it's valuable, is go to my website, ruleinvestmentmedia.com. List your natural resource stocks, and for free, no obligation. I'll personally rank them. I rank them 1 to 10. My rankings are very harsh, so don't be discouraged. And I'm just back from 3 weeks away, so I'm about 10 days behind. So don't be mad if you don't get your rankings back right away. You know, leave an old guy to go slow. Please, no pot stocks, no tech stocks, no crypto. Use my information for what it's good for, which is natural resource stocks only. Rule Investment Media. The second thing is, from time to time, I teach courses. I put on a conference, which you went to last year. I humbly believe it's the best natural resource conference on the planet. You can attend live, that would be my preference, or you can attend online, comfort and convenience of your own house. In either case, absolutely, positively, money back guarantee. RuleSymposium.com. Every 90 days at the Rule Classroom, ruleclassroom.com or ruleinvestmentmedia.com, we take a deep dive into one aspect or another of natural resource investing. We've done silver, we've done uranium, we've done royalty and streaming, we've done advanced exploration, prospect generation, development. We just did tier 1 deposits. These are an 8-hour-long, deep dive into one topic. You'll have access to the recordings for a year, and you'll need them because we give you more information in 8 hours than you can absorb in 8 hours. It's going to take you 25 hours to get the information down. Now, Tom, this is not a place for tourists. If you're in this game because you got a hunch and you want to bet a bunch, this is the wrong place. These aren't the funnies. This is the real thing. There's an absolute money back guarantee, but please be prepared to work. $99 tuition, full money back guarantee if you don't think you got your money's worth. Finally, if you live in the United States or Canada and you are unhappy with your current bank, I don't know why that would be. Maybe they don't pay you interest on your checking account. Maybe when you call, you can't get a living, breathing human being. I don't know. But if for any reason you're unhappy with your current bank, check out battlebank.com. We believe that we can address a lot of the shortcomings of other banks. In particular, if you hold gold or silver in segregated storage and you would like access to credit on your gold and silver, for some reason, no other American or Canadian bank believes gold is good collateral. I beg to differ. So if you want to explore establishing a credit facility against your physical holdings of gold and silver, come see Battlebank, either at battlebank.com or at ruleinvestmentmedia.com. In the question and answer section, where you listed your natural resource stocks, just write bank and I'll send you the information.
Perfect. Rick, again, thank you so much for your time today. For anybody that wants to follow Rick on Twitter as well, at RealRickRule. Rick, always a pleasure, sir.
Tom, my pleasure. Thank you for the opportunity. I look forward to seeing you in Boca again this coming year.
Absolutely. Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.